kick off this morning from Christof Rühl in Germany, senior research scholar at the Center on Global Energy Policy at Columbia University. Christof, good morning. Would it be just presumptuous to say that the only thing to take away from last week was the OPEC decision? What are your thoughts?
Well, that's one, but it's not the only one, I think. Good morning. I think we have 4 points. 3 of them are one-offs, and the 4th is something which will be with us for a while until January. The one-offs, I think, is the unemployment report in the US is actually important this time because we see how the country struggles to get out economically from the COVID restrictions. So this is a very strange situation. You have an increase in infection rates, an increase in fatality rates, an increase in hospital stays and all of that. At the same time, you have in aggregate a decrease in lockdown severity and all that. And the third one, you have now a marked slowdown in the economy. So the new employment was less than expected, and there is a substantial amount of people dropping out of the labor force, meaning they've given up searching, and if they do that, they're not registered. So that leads to unofficial estimates of the current unemployment rate of about 12% instead of 6.5% or so. So that's a slowdown, which is bad news. And I think before we come to OPEC, the second one-off point this week was from a small country in Europe, was Denmark, which announced that they would stop oil and gas exploration only by 2050, but in line with their carbon neutral target. It's a small producer, 103,000 barrels per day or something, but I think it's a significant step because it, of course, raises the specter of Europe getting the oil, which they undoubtedly will still need 20, 30, 40 years from now, exclusively from the outside and starving their own resources and probably down the line also their own companies from getting into that business. And whether that's wise or not is something else, but that's a significant step. And the third one, of course, was the OPEC meeting. And I'm sure we will discuss it at length, so I'll be very brief. It reminds me a little bit this strategy of cutting 500,000 now and then leaving it open and meeting monthly. This is like trying to operate from a playbook taken from central banks, right? So you make a first step, you have a long-term goal in mind, which is normality, presumably at a low spare capacity, and then you go and manage expectations and your own cohesiveness and everything else. In a step-by-step fashion. It won't work because it's a coalition of many players, not a single institution, but it's an interesting sort of trying, again, another interesting twist in trying to stay on course, which they try very hard and so far very successfully. So and then I think there's a 4th point, a summary of points, which will be with us for a while, and this is, I would call that Joe Biden's to-do list. Right? We saw some examples. One is the future of the trade deal between the US and China, where China is obliged to take a large amount of energy and buy it from the US. It's not clear what that happens, whether that will be just canned, whether they start at zero, whether this will be a reason for arguments. Another example on that to-do list is Iran's announcement. Surprised me that they even admitted it, but they announced to the watchdog for nuclear energy that they would use now 2nd and 3rd generation centrifuge, something which they are not allowed to do under the nuclear deal. Now you can say the nuclear deal is dead, and politically and morally that's probably the case after what Trump did, but legally the deal is there and the US just walked away from it, so they can come back, which is what Biden promised to do, provided the Iranians would in the meantime stick to the rules agreed 4 years ago. That's a tall order, you walk away from a deal and says, but you maintain the rules, and then maybe, but the Iranians have now clearly indicated that they don't intend to maintain the rules, and so the question is.
Well, the negotiation begins. No, you go first. No,
somebody has to give in, yeah. And the last on this to-do list is the CNOC, putting CNOC not on a sanctions list, but allowing or disallowing, not allowing American companies to invest in CNOC anymore and to finance it. And this raises this whole specter of sanctions in the energy space and all of that. All of that piles up on this to-do list because we, from the outside, really don't know what kind of policies Biden wants to pursue in these kind of issues. And they all touch on energy, of course.
Yeah, they certainly, increasingly the number of complications that sit in front of a Biden administration, whatever optimism you may have of a new beginning, there's certainly no shortage of hurdles that have to be jumped over. Mike Muller.
That's how I would cut this. Yeah, so separate points, 3 of them, and then We should probably keeping track of this Joe Biden's to-do list.
Yes.
I have the feeling, like you said, it will become rather extensive.
Mike Muller, head of Vitol Asia. Good morning, Mike. Welcome back to the table. Again, same to you. Maybe you could dig a little deeper into the OPEC. When we met last week, we were sort of looking at the rollover. We got a sort of a compromise. What are your thoughts about that compromise and the general view on the whole deal?
Yes, we clearly got some insights into the new dynamic in OPEC and core OPEC at that. I mean, I can't help feel that there'll be some amazement, not just from onlookers, but from people inside the club, that it was the UAE that proved the stumbling block, when others, arguably from an outside perspective, have a much stronger case to be arguing for leniency. Of course, we know the UAE has invested substantially in having extra production capacity. And you could argue also that they got caught at a particularly unfortunate snapshot in time when the baseline was set in terms of October 2018 production for the agreement that was hacked out in a rush, and it had to be in a rush back in April. But yes, there was clearly some expert diplomacy going on behind the scenes on Wednesday night and on Thursday. And I've got no doubt in my mind at all that our friend Mohammed Barkindo, I'm pleased to see you've got him on your January 13th as your banner keynote speaker. Well done, Sean. Presumably did his usual smooth diplomacy behind the scenes, and I'm sure that the leading echelons of both the Emirates and Saudi had conversations also in order to come up with an agreement that the market greeted with relatively positive response. Don't forget, I mean, the market did close on a high the previous week. It then sagged off, and of course didn't very much like the undertones of discord within core OPEC. And that's all the market sagged down a little bit, still the high 40s, of course. But the fact that the market took the news late Thursday, our time, so mid-Thursday everywhere else, as positive and pushed up to very, very close to $50 a barrel is an indication of the following. The market is maybe not willing to admit this up front, but it had publicized an expectation that there would be no production increase at all, and the 2 million barrels a day would not hit the market until April. In reality, and we've said this in previous calls, during the course of the second half of November, the world has had a little bit more granularity on demand impact of wave 2 of the virus, and it has not been anything near as bad as people had feared earlier in the month. And therefore, it was right for OPEC to take its time, even though the decision comes way too late in terms of the January trading cycle. It took its time and then took a view collectively in the end that an extra 500,000 barrels a day on the market would not do any damage, and the market clearly agrees with that. Now, I mean,
ultimately, Mike, sorry, just to interrupt there, on the point of the structure of this incremental, obviously moving away from the 2 million barrel a day increase to a 500, structurally, this deal, as you said, was put in together in a hurry. It was very unrealistic in retrospect to think, well, you can put 2 million barrels on the market in a single day or a single moment, or indeed looking forward that you can put 5.8 million barrels onto the market April 2022 or whatever the time frame is. So my question is, ultimately, should we now look at this deal a little bit differently, as it's 500,000 from here on in, and each month we can do more or less, that these bigger sort of headline numbers shouldn't be the yardstick?
I don't think anybody ever felt that it was going to be 2 million in one hit on the 1st of January. And as you say, the 5-point-something million barrels a day in early 22. It was always going to be phased. It was always going to be subject to a meeting like this. Now, I think the outcome of the meeting was that a maximum of a further 500,000 barrels a day can be discussed and put on the market for the next month, February, and then again for March. So that means we'll never have the full 2 million barrels a day on the market. And as such, OPEC have pared back and done the right thing in light of the questionable demand, given the winter virus conditions we still have ahead of any vaccine impact. But yes, it is a shift in dynamic, in a big way. And for them to call a full ministerial meeting every month at a point in time, and this is important, right? At a point in time when certain OPEC barrels have already been placed, allocated to market, namely in those countries that happen to have foreign producers like Iraq and the Emirates and Oman, whereas those other countries where the state oil company is the sole producer, and the oil tends to be not tradable, there's an allocation process which will pan out. I haven't checked whether it's already out, but the programs for January will get issued today, tomorrow for Saudi Arabia, Kuwait, and countries like this. And there it's a question of allocating term customers their oil, and that's it. They get what they're given. And under OPEC restraint, of course, that means they get less than their contractual quantity, and that's normally accepted. But you have this mismatch of the former group of countries having already placed their oil, and the latter group of countries allocating later. And as such, Saudi, Kuwait, just name two companies, always go later. And if there's a need to tighten things up a little bit, there might be a natural tendency on their part to exercise restraint in the knowledge of what's happened with the other countries. The only other response is that Oman and Abu Dhabi, whose January oil is all placed and whose foreign participants in country have already had to decide how much to sell on an assumption that they're going to produce a certain amount of oil, to pull back volume. And we do have the precedent. The biggest one was back in May after the April Accord, when the Emirates indeed, or ADNOC, ended up taking something like 150,000 barrels off each 500,000 barrel parcel of oil, just in order to create that necessary reduction in availability to the market. And that sends the industry scrambling to fill their ships, because of course you can't have half-empty ships. In a smaller way, that is a plausible outcome we're going to see now, but we don't have the decision yet.
Sorry, Christof.
Yeah, I'm thinking this is not new, right? I mean, you always had what is new is the regularity, but you always had a sequencing problem of selling and producing, which is a one-off, and then you have it cast in stone, or you have another dimension along which people can adjust or cheat or whatever you want to call it. I think what is important to recognize is that this was more like herding cats again. This is not. It didn't appear from the outside. I drew this comparison with a central bank, which would disappear in a room, close the doors, come up with a coherent policy, and concentrate heavily on the credibility of that policy with markets. This is not what happens here. There's a lot of bickering going on before. There's a lot of, Kazakhstan suddenly raising its voice, everybody thinking it must be Russia speaking, and all these things we are used to, including allowing those who have cheated sort of to get away with it again, which are familiar from previous meetings. And I think it's still much better executed from what I've seen in history, and that is the strong hand of Saudi Arabia. And I just wonder, how long that, whether that comes to a breaking point at some point, when the race is on for producing more because the economy is finally taken off.
Christof, speaking of herding cats, the outcome of the developments in the US last week also appeared to be the momentum back onto the stimulus, and that for the first time in a while, it does feel like the Congress are kind of getting onto the same page for a package that will sort of bail out the 12 million that are facing the loss of their welfare benefits at the end of the month. What are your thoughts on the significance of that? Will it have an impact for the markets?
Yeah, this becomes a very complicated, very political song and dance now. So for everybody's background, it's the Democrats pushing for this really super huge 2 trillion stimulus package, and the Republicans sort of promising them to meet them at about half of that. That looks likely to happen. The big question is underneath these aggregate numbers is whether they can managed to agree on reinstating these $1,200 checks, which have been mailed out. That is important because it is maybe mistargeted some instances and all that, but this is the fastest, the quickest, and the most effective bridge for people to survive and to actually have cash to spend, which we have in that system, or which they have in that system, has proven to be quite effective during the first wave. If it doesn't come, you will see more misery and therefore more of this antagonism in the society, a harder job for Biden, and slower growth at the end of the day. If it does happen, Biden's start would be much smoother and the public support would be probably much larger. And so it's not necessarily something which Republicans want to happen, but it's also such an obvious social problem that they cannot openly say we don't want it to happen. And that's where all this bickering comes in. My best guess, which is not worth very much, is that we will see the 900 something billion package, the smaller one, and a probably scaled down, but still a version of cash transfers, because it's hard to see how a lot of people can survive without. And remember, a lot of these low wage receivers, they were actually going in Florida and other places last minute, switching Latinos and others, blacks, to vote for Trump, because he said, we will not shut down. And because it was their jobs in a burger joint or in a hotel, whatever, which were on the line by these shutdowns, first of all. So there is a group of people who really depend on that.
Mike, the outcome of last week obviously is a question about what looking forward. Is this a case where the drawn out negotiation instills confidence in the market for the longevity of this agreement, or does it instill concern? Confidence because they came to an agreement, a consensus, concern because there's obviously fractures. How do you see those two things underpinning the market moving into the new year?
More confidence, I think. The market was generally relieved that it got what, as I said earlier, it pretty much expected all along, which is a tapering of the big lumps in supply change to market. And yes, all this talk that's there've been musings about whether key corporate central countries should remain members of OPEC or not. That was never really in question. I mean, the market discounted that. So I think it's a positive sign that OPEC cohesion is in place. What is remarkable is how OPEC over the last few months has indeed managed to get countries that had been overproducing to rein in production and make these compensation moves. Iraq first and foremost there, and that is a very strong thing. And if there's any evidence that that's continuing into Q1, the market will continue to have great faith in OPEC as an institution and its ability to hold things together, despite the wobbles earlier in the middle of last week.
And then what happens if we reach 50 and 55 and production in the US is going up?
This is critical. I mean, I think we should talk about, there's a very good point, Christof. The shape of the curve is fascinating because, of course, the front of the market has come up. We have backwardation in 2021, Brent spreads, etc. But there was heavy back-end selling, and that selling is coming from US producers, those very people you're hinting at.
and production
OPEC's
is going
mission,
up. And shale is not dead. You know, those people are all wrong who claimed that. Production in the US is picking up already. You know?
Yeah. So that hedging is clearly not on a huge scale yet, but it is a very resilient sector. It has shown us in past cycles that it can cope with lower prices because the cost cycle just moves in step with that. And OPEC's mission is somehow to keep the back end of the market at a level where these guys aren't going to hedge because it's not yet attractive enough to do so. And that means the back end has to stay in the mid 40s or thereabouts, but they'd love the front end to come to 60. And of course, 60 at the front, 40 at the back is a market that doesn't exist. That's a hyper tight market with super backwardation.
I suppose the idea of this incremental, this monthly incremental revisit to the marketplace does keep the shale a little bit on its toes as to whether it can make the commitment to go back in a way. It sort of acts both offensively as well as defensively.
Don't forget that the response time of shale is much, much shorter than what we used historically. So to me, it still makes, this is still all a harbinger of things to come. The huge expansion of productive capacity among low-cost producers in the face of low demand, preparation of the fight for volumes later. And it makes sense to me to look at the current situation also as a global battle for market share, because you have obviously the market share controlled by OPEC Plus, and then you have this very fast response time in shale. You have all the DUCs, the drilled but uncompleted wells, which are waiting there to be taken on, and you have the threat of hedging on the horizon. You know that a price spike is enough for some of these guys to lock in production for a year, and this is, I think, that's where you're right. So this gradual tiptoeing, also, this is what it's all about. It's a strategic game of controlling global market share, and I just cannot see it working.
I remember it reminds me of a similar strategy as the late 90s when prices headed to $10, and then OPEC moved into this very micromanagement structure monthly. I mean, they met nearly 8 times a year and incrementally lifted the market quite successfully under Naomi, and quite disciplined as well. Let's go to the first survey question just on this point as to what the mood in the room is regarding will OPEC agreement survive through to the end of the agreed period in April 2022? It's kind of the big picture view, and sort of welcome where the sentiment is in that. Mike, I wanted to bring up the other point that's in the digest today, an outcome of the fact that the US is now exporting increasingly larger amounts of oil, and that Platts have announced the inclusion of WTI into the dated Brent basket, or at least the exploration of that. A, could you explain its logic, and B, does it make sense to you? What is the market's reaction?
Okay, on the exports first, I actually exchanged some views with the company whose article you put on your digest, which is Argus Media,
right?
Because they had included some Canadian exports, which of course come through the US Gulf as well. And just for the benefit of those who didn't read it first, I mean, it highlights that China is the biggest taker, largely because of the energy accord, the trade deal that Christof mentioned before. And then the second biggest market is Europe, and US and Midland WTI in particular has been going to Europe in very, very large quantities of late. The figure cited in the S&P Global Platts article on this was something like 440,000 barrels per day. And the Netherlands alone, which is a small country, but with a big refining base, is up in the 250,000 barrels a day of Midland crude consumption. So it has become a steady flow, so much so that many North Sea trading teams have begun to merge with Midland traders in order to work the overall supply capability together. So the Platts consultation is not new. They signaled back in early 19, or it could even be 2018, that this was an intention for the future, but they've now come up with a proposed date, which is to implement this from March 2022. So since the frontline Brent futures is now February 21, we have 13 months notice that this is what Platts intend to do. And when Platts launch a consultation after already signaling it to the market, it's normally an intention on theirs, and they're looking for guidance rather than for people to say, no, don't do it. So I think this is something that Platts wants to do, and the industry will have, I believe, until January sometime to give feedback on this, or even February. The view is that Platts will allow assessments for a FOB Scapa flow. So you bring your VLCC all the way from the US Gulf to the Orkney Islands and put it in the safe sheltered waters where you do transshipments, and you offer Midland crude into the North Sea market alongside the other 5 grades that are already in place: Brent, Forties, Oseberg, Ekofisk, and Troll. And of course, Brent itself has 2 former grades. What's the purpose of all this? Well, it's the same as usual. You've had this decline in these baseload grades, and it's never a good thing for a benchmark to be pegged against a shrinking supply base, because that gives you risks at times of disruption, or in strong markets where the benchmark can get stronger than maybe it should be because there's just a finite supply base. So it's all about creating a bigger supply base. This is therefore a volatility reducing and upside controlling move on the part of Platts, which has always gone down reasonably well with the refiners. Yeah.
Isn't it also something of which we should expect more, precisely because it's supposed to counter the shrinking volumes of Brent?
Yes, absolutely. So it's been a trend, which is why you've got 5 letters in the alphabet BFOET in the first place. But there's another thing to it here. A lot of the new production in the Northwest European market has been different quality, and there's a strong desire to keep the quality at the light sweet end of the bracket. And it's the light sweet crudes in the North Sea that are declining. And of course, no investment coming in Denmark. There was a big debate whether the Danish underground consortium, the duck crude, should be part of the benchmark too to make it BFOETD. That's not on the table now. But let's be honest here. The North Sea market is a proxy for delivered oil in the ARA Rotterdam area, and it already prices extremely efficiently. When it goes out of whack because somebody's bidding up the 40s market, for example, people substitute, and a refiner will buy Urals instead, or they'll buy Nigerian, or they'll buy Caspian crude instead. Very, very efficiently so. So I've argued in the past that it's not necessary for Platts to keep putting grades in there when the market keeps itself in check anyway, so long as the assessment windows reflect a window in time where it is possible for those refiners to make those economic switches and to buy Urals, or to buy Kazakh crude, or to buy Midland.
So
not
the
necessarily.
reason I was asking is, will that have the potential to depress or to make less volatile the WTI Brent differentials, or not? Down the road, not this one.
That is an automatic assumption. Most people are reaching that conclusion. I agree, Christof. Yes, it is likely to do so, because of course you're now trying to link together the 2 big global benchmarks in Western Hemisphere crude, one of the 2 biggest global benchmarks. But of course, let's not forget Midland is not the same as Oklahoma Cushing TI. That's a pretty different number, right?
And it's also happening, sorry, I was just going to try and cut it off, happening at the same time this Murban contract is coming into play in the March here in the UAE, which is...
That's why I said Western Hemisphere.
Western Hemisphere, there you go. Which is a similarly composed crude, sweet, light crude. Christof, before we get too distracted, I wanted to get your views deeper on the other point you brought up at the beginning, the sanctioning of CNOOC, and what does that tell us about the future? What is it an important development, do you think, and why?
Yeah, this has had me baffled when I heard about it. It's not sanctioning, actually. It is what's it called, blacklisting or black some, I forgot the exact term, but it is essentially telling American financiers, private individuals and companies not to invest and to in fact divest any shares or stocks or financial relations they had. And this is mostly concentrated in a subsidiary of CNOOC in Hong Kong for technical reasons. That was the arm where we could invest in, because CNOOC being a state company is more difficult. I don't quite understand. I think this is probably, but I don't know it. I think this is probably some of the last twitches of the diehards in the Treasury, which have been sent there by the Trump administration to push sanctions all around. I mean, the US has like something like 30 odd countries against which they have sanctions and thousands of individuals against which they have economic sanctions. So that jumped up. Could be a last hooray on that front. If it would be sort of coordinated, I can't imagine that, but if it would be coordinated with the incoming Biden team, then it would be bad news for everyone, because that would mean that the silly sort of anti-globalization, anti-China, indiscriminate moves would continue. I didn't find a reason. So this was not that CNOOC was accused of doing something and then, punished in some measure and scalability and something.
Well, as you mentioned last week, it's kind of this scorched earth policy can include a lot from the Trump, and there's still a month and a half to go. Let's go to the survey result, because we have a quick second survey question I'd like to ask. So yes, OPEC agreement will survive. The second question is just a sort of a switch on the same topic. And it's sort of the point I asked Mike a little while ago, that what was the outcome or the consequence of the discussions this week? So we could bring up the second survey question. Irene, if it's ready, basically, does the outcome of does the OPEC drawn out deal making embed confidence or concern for OPEC plus cohesion in 2021? Is it confidence? I don't know what that third answer should be, not there, but just ignore answer number 3. That's a typo. So either does the drawn out deal making embed confidence or concern for 2021, and disregard the third answer. Let's go to sort of closing thoughts, Mike. The week ahead, obviously, all of these moving parts are still in place. What will you be watching, do you think, and guiding the markets this week?
Yeah, Christof already touched on the many actions by the outgoing Trump administration. One to watch, I guess, is the flotilla of Iranian vessels with their transponders off heading to Venezuela that was in the papers earlier today. Some people in the Twitter sphere have been scaremongering around the CNOOC news that CNOOC are a big producer of buzzard crude, which is 40s, and that could affect the benchmark. I think that's nonsense. That's taking things too far. The big issue really is around demand. I mean, it would appear from mobility data that the virus, that COVID in Europe has been largely kept under check as opposed to in the US. However, it is in Europe that the demand impact was greater. In the US, through Thanksgiving, demand was pretty much static. So the hit on demand is much less, and the big focus now is on how soon will the vaccine be in place and what is confidence in flying looking like, because the big piece of demand that the world is missing is jet fuel. And as we look forward, the market seems to have already priced this in, because jet fuel, diesel, cracks in general made a really big jump last week. So in relative value, people are already pricing in a recovery in jet demand. And is the market getting ahead of itself, or are people really getting confident? And that comes down to questions like how many people are going to step forward and take the vaccine as soon as it's available? And at what point of vaccine rollouts will herd immunity be in place such that we can return to normal? Will it be in time for APEC next year, which has been my big advertising
well, you won't have to get on an airplane for that one. But hopefully we will, is the other half of that comment. Christof, it is the battle, isn't it? Ultimately, I think the US possibly following Europe into a double dip recession versus the euphoria of the vaccine and the reality of what it brings. How do you see those two things playing out?
Yeah, I think we have two items here. One is exactly that. Will Biden, have the opportunity, and will he actually aim for a policy of more lockdowns and then keeping the economy on an even keel by using public funds, for using these big stimulus packages? Or will it continue to be more free-for-all with stronger economic growth, but also escalating virus things, which now seems to be running into serious trouble? So you can escalate the virus so far, then the economy will stop even without a lockdown. We seem to be getting closer to. So that's one. The other one is what you said, not exactly scorched earth anymore because most of the guys are out, but what the last twitches of a dying beast, what the Trump administration can do to obscure an easy start for the Biden administration. But that's dying away. I think it's not so important. Otherwise, I mean, we're in December, right? And it has been a year with lots of news for everyone. So I would expect it sort of suddenly to starting to slowly, hopefully unwind and calm down towards Christmas and the new year.
Yeah.
And then you'll start that with a big discussion on how do you allocate, I don't know, a few 100 million vaccinations that cost 7.6 billion people. That's going to be an interesting one too.
Well, I think we'll be waiting our turn out here in the outer reaches of the empire. But one of the good things about waiting your turn, I suppose, it will be that you'll be able to see how the first few weeks or months of this rollout happen. Hopefully, they'll all be very successful. Let's just close.
They will go where the money is first, probably.
Yeah, well, that's true. I suppose Pfizer is a business. Let's get the answer to the second survey question as a closing sort of regard. The confidence concern, 2-to-1 concern over confidence. I think that would be one to watch nonetheless, where the market feels this. And I think that obviously the proof will be in the pudding, so to speak, as to whether the discipline sustains in the OPEC plus 23 countries or will have a continued erosion. Mike Muller, as always, thank you very much for plugging in from Singapore on your Sunday afternoon. Christof Rühl from Germany on your very early Sunday morning. You're up in time to go to church, I suppose, or something like that. But nonetheless, thank you guys. And thank you for everybody for plugging in. Have a great week. We'll catch up with you in the coming days. All the best.
See you next Sunday. Bye.
Cheers.
Thanks.
Bye, Mike.